Welcome to the Valuation Desk by Highland Global, where SBA business valuations speak bank. Let me start with a question. If a small business has no patents, no real estate, and its equipment is fully depreciated, why is it still worth $1 million? The answer lies in one concept: intangible assets. In this session, we're diving into a critical but often misunderstood aspect of SBA loan underwriting: intangible value. This includes everything from customer relationships to trade names, proprietary processes, and of course, goodwill. As lenders, you know that when you finance a business acquisition, you're often financing more than just inventory and equipment. You're financing the reputation, the brand, the loyal customer base, and the secret sauce that makes the business tick. With SBA loans, valuation of intangibles is always under the microscope, especially when goodwill is a large part of the deal. So let's unpack what this means for you as a lender and how you can review valuations with confidence and compliance in mind. Let's begin with the basics. In business valuation, we separate identifiable intangible assets from goodwill. Identifiable intangibles are assets you can isolate, define, and sometimes even sell on their own. Think of things like a trademarked brand name, a customer list, a proprietary recipe, a contract, a patent. These are all examples of intangibles that meet accounting and valuation standards for being separately identifiable. They have a legal basis or can be transferred. Now contrast that with goodwill. Goodwill is what's left over after you subtract the value of all identifiable assets, tangible and intangible, from the total enterprise value. Goodwill is the catch-all. It's the reputation, the going concern value, the assembled workforce, the experience of the founder. It can't be separated or sold. You can't put it in a box. And in SBA lending, it's considered higher risk because it has no collateral value. So how do we value these things? For identifiable intangibles, valuation professionals use income-based methods, the most common being the relief from royalty method for trademarks and trade names, the with and without method for proprietary processes, recipes, or non-competes. Let me give you an example. Suppose you're lending on the purchase of a regional hot sauce company. It has no patents, but its brand name is well known in the Carolinas. The appraiser might apply a royalty rate of 3% of revenue based on industry data from other condiment licensing deals and discount those saved royalty payments to present value. Voila! The value of the brand might come in at $800,000. That's the relief from royalty method in action. Meanwhile, goodwill is usually not directly valued. Instead, it's the residual. The business appraiser values the business as a whole, then values the tangible assets and identifiable intangibles. Whatever's left is goodwill. And that's why goodwill is a red flag if it's the bulk of the purchase price. It means there are few hard assets and even fewer intangible ones that can be isolated and measured. Now let's dig just a bit deeper into that relief from royalty method because it's one of the most commonly misunderstood tools in intangible valuation. The logic is simple. If I don't own the brand name, I have to pay someone else a royalty to use it. But because I do own it, I'm saving that money. So the value of the trademark is the present value of those future royalty savings. We start by projecting the company's future revenues related to the trademark. Applying a reasonable royalty rate, say 2% to 4% for food brands based on market benchmarks. Tax affecting that savings, since the royalty would have been a tax-deductible expense. Discounting the after-tax savings to present value using a rate that reflects risk. Let me be clear here. The choice of royalty rate is key. That number needs to be grounded in real-world data, often pulled from databases like Royalty Source or KT Mine. It needs to match the size, margins, and uniqueness of the business. A national brand will warrant a higher royalty rate than a local mom-and-pop name. If you're reviewing an appraisal and the report says, "We applied a 4% royalty," your follow-up question should be, where did that number come from? Let's make it tangible with a food industry example. Take a restaurant chain acquisition. The fair market value of the enterprise was estimated at $950,000. The appraisal might show the following breakdown: $200,000 in equipment, $70,000 for the trade name via relief from royalty, $30,000 for the proprietary menu, and the remaining $650,000? Goodwill. As a lender, what should you take from this? When the appraisal breaks down the price into identifiable components and shows the math and market data behind them, you're in a good place. You can understand what your borrower is really buying and what your loan is really funding. Let's bring this home with what SBA SOP 5010-8 requires. When a business acquisition involves intangible assets, and that includes goodwill, the SBA requires a business valuation from a qualified source, a minimum 10% equity injection, careful scrutiny of assumptions used in the valuation. The SOP does not prohibit goodwill, but it does demand that the lender confirm the valuation is credible, that the price is reasonable, and that the borrower has real skin in the game. So your job is not to become a valuation expert overnight, but to ask the right questions. Does the report break out tangible and intangible value? Are identifiable intangibles like trademarks or customer lists valued separately using accepted methods? Are market-based inputs, like royalty rates, cited and explained? Is the goodwill portion justified by the business's actual cash flow? Does the appraiser hold a relevant credential like ASA, ABV, or CVA? When you get a clear yes to these questions, your file is SBA audit ready, and you've done your part to manage risk. To wrap up, intangibles matter. They may not be visible, but they often drive the lion's share of business value. As lenders, your job is to ensure that what's being financed is real, measurable, and reasonably valued. The good news is, there are tools to do just that. Relief from royalty, valuation standards like US PAP, and a network of qualified appraisers who can help you interpret what's behind the numbers. So the next time you see a deal with 60% goodwill, don't panic. Just ask the right questions, read the appraisal carefully, and remember, you now know what's in a name. Thanks for joining us for this episode of the Valuation Desk. Behind every financial model and final value is a professional who knows how to interpret the story behind the numbers. At Highland Global, our depth of experience ensures that your appraisal isn't just technically sound, it's contextually accurate, SBA compliant, and thoughtfully reasoned. We've prepared thousands of business valuations and machinery appraisals, and we understand the details that make or break a deal. Because in lending, it's not just about the math, it's about the judgment behind it. For more information on valuation-related topics, be sure to visit our website, highlandglobal.com. Lenders know experience matters most.